What is up, guys? My name is Hassan, and welcome back, everyone. Hashtag good investing. If you guys have been following me for some time, you know that I like companies with very little debt or no debt, and more importantly, companies that pay zero interest. And you guys can see here, my portfolio is currently around $25,000, a little bit up. Up around 16% for the year. And on the right side, we have companies that I'm currently holding. About 8 companies that you guys can see right here, like KL, AMD, Baozong, Texas, Nvidia, 3M, Johnson and Johnson. So today we're going to give you guys a stock analysis on the company Future Fuel, ticker symbol FF. It's a solid company, a wonderful company, and that has many things going right for itself. Before we get started, I just want to quickly talk about why it's really important to invest in companies with little to no debt and companies that also pay dividend. I just want to highlight this because this is a very important concept. Today we're going to go through a stock analysis and the method that you guys can use it for any single company you like, as long as you're following through with the whole method from beginning to end. So companies that take on a lot of debt sometimes have trouble making it through the difficult times, such as during the dot-com bubble or during the pandemic or the housing crisis. Companies that take on a lot of debt run into a lot of trouble, and sometimes they go broke, such as Hertz that comes to mind, or Sears or J.C. Penney, or the fracking companies or the oil industry or Pier 1 and so on. You guys get the point. So as a long-term investor, I highly recommend you guys stay away. The general rule is that if a company has a huge amount of debt and is paying a lot of interest, that is a big red flag. So we're going to give you guys an example of, say, Cliff or Abbey. Even though I love Abbey, Abbey is a great company, but their debt ratio, the amount of debt they have is crazy. So we're at Cleveland Cliff. Their price is right now $8.39. If we scroll down, and we can see that their long-term debt is around 4.3 billion. And if we scroll up and we look at their market cap is 3.4 billion. Initially, they have a lot more debt than their market cap. So this is a company that is a very, very red flag, and we want to stay away from it. So here is showing us that in 5 years, they're up 225%. I think that this is very misleading. If you're able to hold it at this price at 234, but for the most part, say from 2017 to 2021, for the last 4 or 5 years, it's been relatively flat. For a long-term investor, yes, this is great for swing trading, but as a long-term investor, this is a nightmare. Did not make money, or you would sell out at a break-even price. My point is that you want to stay away from companies that have huge amount of debt, even more debt than their market cap. And this is how you get into trouble. Companies that have little to no debt do exist, and during times of uncertainty, these are the companies that everybody wants to invest into. As always, before we continue, I have to give you guys a quick disclaimer. I'm not a financial advisor, nor do I know you personally or your financial situation. I am not responsible for any of your gains or losses in the stock market. My suggestions are only suggestions. That does not mean you go out and buy these stocks. It is just a place for you to start your own due diligence. Remember, just because I buy something, that doesn't mean you should buy it. Disclaimer that I want to present to you guys, that all the information that I present to you are not mine. I get them from other people, other investors, from magazines, newspapers, videos, books, articles, reports. The only thing that might be mine are my emotion and my experience. Another thing, that if you're going to follow somebody on YouTube, they should have a proven track record before you take their advice. A lot of these investors who are out there, and a lot of these YouTubers who are out there, they don't even show you their portfolio, or they show you once in a while when it's up massively, and then they disappear for a year until good times come back, and they're like, oh, look, I'm up 30%, I'm up 40%. But the whole year they were pretty much silent. I want to quickly go over my holdings and how I have been doing for the last year or so. In that way, you guys are able to hold me accountable. I'm not a person who only who talk about investing. I actually do it. So let's take you guys back. The market is still alive. Literally, it's about to close in 1 minute. So currently for one day, I'm down about $67 or 0%. If we look at it for 1 week, I'm down about 2%, and But these are great buying opportunities right here. I did some buying around here. Every time it dips, I try to get in on the market. And then we look at for 1 month, I'm up only 2%. And then if we look at it for 3 months, I'm up around 5.4% or 5.5%. And then if we look at it for the 1 year, I'm up about almost 16% or 15.6%. So let's get started. So we're at Seeking Alpha, ticker symbol FF. The company is called Future Fuel. So pretty much Future Fuel is a chemical company that manufactures and sells diversified chemicals and bio-based fuel and bio-based pretty much chemical products in the United States. So they pretty much have two segments here. One is like a chemical company, the other one is biofuels. And in a minute, we're going to be talking about what type of biofuels are they and what are their usage are. So we're going to take you guys to Seeking Alpha. Again, right here, biofuels or future fuels. Currently, their market cap is around 550 or 525 million. The great thing about this company is that their price to earning ratio is 4.6. This is amazing. Anything under 5, as long as it's not a value trap, it is great. Another thing that I want to point out is that yes, their PE is 4.6, but their earning per share per year is $2.59. So every year they're making $2.59 in profit, which is amazing, which is a lot in comparison to its $12 price. And this is one of the main reasons why I like this company, is that this is a great value, a solid company with a great earnings and with a great price. Whenever we're doing a stock analysis video, we should always go to our 10K or the annual report. So I'm going to pull up the 2019 annual report for Future Fuel, and we're going to go scroll down. Pretty much it's right here. So they're talking about their business. You have to really, in order to invest, you really need to understand the business. That our business is managed into two segments, as we talked about. One is chemicals, one is biofuel. The chemical segment manufactures a diversified list of chemical products that are sold to third parties. So pretty much they have these chemical products that they're selling to other customers. We can see that this company distributes a cash dividend of 6 cents per share. So every 3 months, just for holding this company, you will get paid 6 cents in dividends. So we're going to talk about a little bit more about the biofuel. We're going to scroll down and we're going to have a little bit better understanding of what this biofuel is. Our biofuel business segments primarily involves the production and the sale of biodiesel and biodiesel blends, buying and selling and shipping of refined petroleum products, which are used for their trucks and other truck industry. So I want to quickly go over some of the usage of this biofuel. So I pulled up an article here. So top 10 uses for biofuels. You can see that here they're holding it for gas stations. They're used for transportation. More than 30% of energy consumed in the United States is used for vehicles. So them producing biofuels has a huge market. Biofuel is also used for generating energy. And then it's used for energy also in a form of heat. It's used in charging electronics, again, energy. Cleaning oil spills, gases, or biofuels is known to be environmental friendly, and it can be used to clean up oil spills and greases. It's also used in our cooking. Biofuel is a form of renewable energy. It reduces the cost and the need to import foreign oils. So pretty much it has its various usage and it's a renewable energy. We're going to try to explain to you guys why this is a great company to look into. So automatically, it's a small cap company. It doesn't have, its market share is only around, it's less than $1 billion, around $500 million. One of the best things about them is that their PE ratio right here is 4.6, which is extremely great value, a great bargain. Another thing that I want to point out is their price to cash flow. This is a very important number. Price, and remember, look at it, it's around 4.9 or 5. I want to quickly go over what does this price to cash flow actually mean. Just like the PE ratio, the lower the number, the better it is for our price to cash flow number. So currently the average price to cash flow for stocks in the S&P 500 is around 14. And based on my understanding, price to cash flow between 0 to 10 provides the best results. And the second best results comes in the range of 10 to 20, and anything over 30 becomes problematic. As we said that the price to cash flow for future fuel is only 5. So I think that we're going to get a ton of value, great price. In the long run, they're going to generate huge amount of cash flow for the investors. We can see the company has a cash of $250 million. We just talked about it, that this company is worth almost a little bit over 500, but half of it is in direct cash. So if we subtract it, this cash from this company, the company is pretty much, we're pretty much buying this company for $250 million after minusing the cash. So this is awesome company to have. And what's really important, why I like about this company, is that if we look at the short-term debt and short and long-term debt, is pretty much zero or non-existing. Company with great amount of cash and short and no debt. So we're going to go up, scroll up, and now we're going to look at the revenue. So before we do that revenue, the concerning part, the biggest red flag in this company is the revenue growth. The revenue growth is negative 30%, which is crazy. We're going to talk a little bit more about this negative 30%. So we're going to go back. The reason why I like Seeking Alpha is because it's very organized. So we're going to go to our financials, and we look at the revenue here, and we can see that the revenue for 2015, 16, 17, 18 was pretty much is around $275 million per year in their revenue. But however, for the year 2019, it dropped from 300,000, it dropped to almost 205,000. So this was a big, almost 30% drop. But if we look at it, look at their gross revenue, we can see that for 2000, even though from 2018 to 2019, their revenues dropped dramatically, but their revenue or their gross profit remained the same. So even though the revenue went down, but they still made a ton of money. So we can see that if we go across, for the most part, you can see 57, 46, 20, okay, it dropped 73, 74, and then for the last trailing 12 months, it's at almost 85. So pretty much it is growing, even though their revenues declined, but their gross profit is continuing to increase, which is a very, very good sign. My concern is the 2019 30% drop. If we look at it in 2018 right here, it was 291, but 2019 it was 205. But if we look at their cost of revenue in 2018, their cost of revenue was around 217 million. Since their revenue dropped, their cost has also dropped dramatically around their cost of revenue dropped to 131, which is a very good or positive sign. So I think that them dropping their revenue is not a big problem because they're going to continue to generate huge amount of cash. If we scroll down as a Muslim investor, I want to point out to the biggest red flag, and which is the interest. We can see that here their interest expense 0.2%. So relatively that is very low. It normally as an investor it should be 0. We wish it was 0. They can easily pay this off because they have so much cash. Then they just, if they wanted to, they can wipe it out. I don't know. And this is the sad part, is that we don't have too much control. Eventually, if we did have millions of shares, maybe we'd be able to advocate and tell them to get rid of this negative point or $200,000 of interest payment that they're making every year, which is nothing. They can get rid of it easily. That's not the concerning. The concerning part is that this company has so much cash, which is actually a good thing. But it's also, as a Muslim investor, is problematic. You can see that here their net interest is increasing in terms of interest income, is increasing year after year. And this is the only reason why I am not investing into this company. For personal reasons, for religious reasons, that their cash interest, since they have cash, they're generating so much money. And that's the only reason I'm not investing in it, is because this company has too much cash. And I think that that's a very good problem to have. to have a lot of cash. But as a Muslim, we do not invest in it. And maybe if things change, I'll look into it, or I might invest in it. But their interest expense is pretty much very low. So since they have a lot of cash, they do reward their shareholders. So we're going to scroll back up and we're going to look at their dividends. Their dividend yield is around 2%. They're paying annually around 24 cents every year per share, which has become 6 cents every quarter. Their 5-year growth is a problem because they did have a massive cut, but I think that this is not a problem because they have a lot of cash and they're going to continue to increase their dividend. They already have a 1-year growth in dividends. So I'm going to show you guys the dividend growth. Yes, even though their 5-year is negative 10%, but for their 1-year dividend growth is around 23%. Their 3-year dividend growth each year is around 5%. So again, we can see here, yes, they had a big, massive dividends here, but they cut it and then they're increasing it back up again. We can see here 15 cents, and then we can see 18 cents, and then we can see 22 cents, and then they also increased it to 20, and now you're going to get 24 cents every year. Another thing I want to point out is that this company has a lot of cash. That means that they reward their shareholders. So now I want to take you guys to the dividend history. We're going to scroll down. This is their dividend history. I can keep in mind this is 2020. Look at the ex-dividend date. We can see that they paid 6 cents, and then they paid a massive special dividend of $3 here in 2020. So if you just hold this company, even if the stock price doesn't move, the company is generating a huge amount of cash. That means the investor are going to get huge amount of cash. This is a great dividend company, a great cash flow company. The one thing I only want you guys to keep in mind is that we want to watch if the revenue is increasing again or not. Or even if the revenue is relatively flat, this company is going to do well because it's generating their PE, price to earnings, is around 4 or 5. We can see 6 cents special dividend. If we go to 2009, 6 cents, 6 cents, good. They're paying 4 times. 2020, they're going to pay us total of 5 times. And then we go to 2018, we can see 666, everything's good. And then if we go to 2017, again, it's 6 cents every quarter. And then if we go to 2016, again, we see 6 cents, but this time we see another $2.29, another special dividend, a massive dividend. So expect them to continue to paying out these massive dividends. You get $2 here, $3 here, and then every year you're getting 24%. So as you hold it on for 5-6 years, yes, the market is not appreciating as much, but you're getting that cash flow. Guys, if you guys made it this far, hopefully I was able to earn a like from you guys. So please smash that like button. And if you haven't subscribed yet, hopefully I was able to earn your subscription. This is my 10th year investing, and we do a lot of fundamental analysis. And we go deep into the company, looking at where they lose money, where they're gaining money, and we look for solid companies. So we're going to scroll down and look at its payout ratio. If you look at their payout ratio, for the most part from 2015, 16, 17, 18, it's all under 20%. That means that the company has a lot of room to grow. And this is considered their health bar, and I understand why they decreased it. Their payout ratio was around 44%. That's why they had to cut it a little bit. But however, they're going to continue to increase their dividend, and this is a very healthy sign. Even at 44%, it's under 50%. I want to show you guys a very, very important thing why I like this company so much is the profitability. So we're in at profitability. And if we scroll down, we can see that their net income for future fuels, the net income margin is at 60%. This is crazy. Their sector medium is 4%. Future fuels net income is around 60%. And that is why their PE is so low. And this is one of the main reasons why I like this company, is because this company is a cash cow, is generating huge amount of money. Huge amount of money for the company means huge amount of money for us shareholders. And as every dip comes, and I would recommend that you guys continue to add every time you guys see the dip. You can see that for 1 year it has a lot of dips, and every time it goes down, you just buy more, add more, and you just let the dividends grow and you can see your monthly income, whatever that you can do, whatever you want with that money. You can go buy sneakers, shoes, take yourself out to a nice dinner. Remember, you're getting 6 cents every quarter. So if you have 100 shares, you're gonna get $6 every 3 months. So this is a great investment company. As always, guys, hopefully you guys subscribed and liked the video. It helps out me producing more videos for you guys. As always, thank you. See you guys next time.